Excellent. Okay. Hello, everyone, and welcome to the Lake Stevens Chamber of Commerce February Chamber Luncheon. We've got a really great, timely topic for you today, taxes. Not something we want to talk about, I know, but it affects all of us, both personally and professionally, and we have some of the best people here to help us today, tax partners from Moss Adams. We'll get to that in a second, but first, a couple of announcements. Just a reminder of our mission here at the Greater Lake Stevens Chamber of Commerce to build a vibrant business community. We've got a few new businesses opening soon, including a donut shop and a gun store opening in downtown, a smokehouse restaurant up in the Frontier Village area, and the grocery outlet is making plans to take over the SARS building. We've also been involved in helping the city with their plans in the Hartford and Machias industrial areas, planning events to better connect our businesses and our community, and we're beginning to form a government advocacy and action committee. These are a few steps we've initiated to further our mission. Opportunities for you to become involved in your chamber in these and other areas are open now, including committees, event planning, those sorts of things. So if you're interested, please reach out to me via my email at director@lakestevenschamber.com or give me a call here at the office. Love to get you hooked up with that. I want to take a moment and thank our gold investors. First off, Ace Hardware here in Lake Stevens. Thank you, Christine. And our other gold investor this year so far, Community Transit. Our 2021 silver investors include Waste Management, Heritage Bank, Wells Fargo, and our new silver investor that just stepped up this last week, First Financial Northwest Bank. Thanks to all of our members and investors for continuing to support the Greater Lake Stevens Chamber of Commerce. Few event reminders for you. Coming up next week is our monthly networking after hours, returning to the Zoom platform this month. We'll be using Zoom we'll be on Zoom from 5 to 6 p.m. next Wednesday from February 17th. So pretty casual, drop by if you can, swing by, say hi, stay for a minute, stay for an hour, how long you like. Love to see you. Oops. Jumped ahead. The next one we have, the following Tuesday, the 23rd of February, will be our morning mingo. This is an informal drop by for a quick chat to get your day started sort of an event happening on the 23rd from 8 a.m. to 9 a.m. Again, also via Zoom. Hope you join us to connect with the business leaders of Lake Stevens in the area at one or both of our monthly networking events. We've had some pretty interesting people at our past couple of months. I know the mayor stops by at our morning mingles. He tries to get to those every once in a while. And we've had city council members, some prominent other business leaders. So it's been good on morning mingles, especially, but as well as our networking after hours. Speaking of the mayor, I just want to mention that next month's luncheon will be another chat, connect with Brett. Mayor Gailey will be on in the March luncheon, and that'll be March 10th. So. And now I'd like to introduce today's speaker from Moss Adams, Phil Knudson. Phil has practiced in public accounting since 2006. He works with closely held businesses and their owners, construction and real estate companies, manufacturing companies, alternative investment vehicles, including hedge funds, private equity funds, and venture capital funds. His areas of expertise include entity structuring, estate and succession planning, complex flow-through tax planning, and partnership allocations and transfers. Please give Phil a warm welcome. Welcome, Phil. Take it away. It's all yours.
Thanks, Matt.
Stop my share here. There you go, sir.
Yeah.
Thank you for being here today. I appreciate you.
Yeah, thanks for having me. I appreciate it. I'm a fellow Lake Stevens. Are we Lake Stevens-ites or Lake Stevensians? Whatever residents of Lake Stevens call it.
You're a little quiet there, Phil. Can you? Is there a way we get closer to the mic here?
Let me try to turn my mic up there.
That's a little better.
Is that better?
Oh yeah, much better. Thank you. Perfect.
All right. I was just saying, I live in Lake Stevens also. I couldn't come up with what the term is for someone that lives in Lake Stevens. Are we Lake Stevens-ites or Lake Stevensonians? I don't know.
Just call us all Vikings for the high school.
Vikings. There you go. Yeah. Well, thanks for letting me join. I like the size of this group is really nice. So hopefully we can like have more of a dialogue as opposed to just me presenting slides throughout. So by all means, you know, interject, interrupt, unmute yourself, wave your hands, do whatever you need to do to get my attention as we go, so that we can touch on whatever it is that's important to you guys. We have some slides prepared just based on content and what we're hearing from our clients and what they're interested in, and just some legislative type updates for you guys. But if we're not touching on what is most important to you, if you have some burning questions, please interrupt and ask those questions so that we can, or that I can touch on those as I go. So let me make sure that I get my screen shared here. Number 3. Can everyone see the slides? Yeah.
Looks good.
Great. Okay. So like I said, I have some slides prepared here that we're gonna touch on. First, I'm gonna go over some state and local tax updates that have been occurring or are on the docket in Washington State, kind of covering a variety of topics there. And then the latter half of the slides will be touching on federal income tax updates and the Biden administration proposals for kind of a planning update there. So that's our agenda for the day: Washington updates, Biden proposals, and then COVID relief provisions, which some of them are old, some of them are they're old, but they're new because of the legislation that passed in December. So we're hearing lots of good questions from clients on these things, so wanted to be able to go over those with everyone today as well. So first, I'm going to touch on some Washington updates here. You may hear in the media or just in conversation and in text, there's part of the governor's budget proposal this year was a proposed capital gains tax in Washington State. Historically, as you're probably aware, in Washington State, we are not able to have an income tax statutorily. It's been voted on in the past. It's been voted down by the voters in the past, and so it's up in the air as to how this capital gains proposal will work, because as a lot of analysis has been done on this, most states view capital gains as income, quote unquote income, and if that's the case, then in theory it's illegal to have an income tax in Washington currently. So, but as it stands, there is a proposed change to the law to apply a capital gains tax in Washington State. It would be 9% on capital gains, and essentially it would look at your federal income tax to determine whether you have a capital gain or not. So if it's showing up on your income tax return as a capital gain, then this 9% tax would apply. There's a threshold, $25,000 of gains or $50,000 for joint filers. So any gains underneath those thresholds would not be subject to this tax. Only for capital gains in excess of those amounts would be subject to the 9% tax. Notably, there's specific things that are exempt. So retirement accounts, that makes sense because retirement accounts are not capital gains, but the sale of a home would not be subject to this. So if you sell your principal residence and you have a gain, the way it's drafted is that would not be subject to this tax as well. And then of course, salaries and wages are not capital gains, so those would not be subject to this tax. So in theory, you're thinking of things like I sold some stocks or bonds, I have a brokerage account, capital gains that are being generated from those types of assets may be subject to this tax. Also, if you're a business owner and you're selling your business, in theory, this tax would also apply to that because that would be generating some capital gain on the disposition of a trade or business as well. So it's out there. It's something to be aware of. Like I said, most of what we're hearing is that folks are thinking that this was not going to go anywhere, just given our Constitution in Washington State not allowing for an income tax. But just want to make sure that everybody's aware that it's out there and something to keep your eye on.
And Phil, that's the one you're talking, the numbers you gave that were for the Senate bill, right? And there's a House bill, competing House bill as well, right? I thought there was. Anyway, but yeah, you're right. I've heard the same things from some people at AWB and such like that. That they're all opposed to it, obviously, and so it's probably not going to go very far. But yeah.
Yep. Okay. In terms of government grants, you know, under a lot of the COVID relief, there's lots of grants, there's lots of exemptions, a lot of relief provisions that are out there. And there has been some proposals to, you know, clarify what is subject to certain types of taxes. You know, are they subject to B&O tax? Are they subject to sales tax? That type of stuff. Most folks in theory think, you know, state grants and relief provisions should not be subject to B&O tax, for example. And so there is some proposal out there that would clarify that and make it clear that kind of stuff is not subject to B&O tax. That's the general understanding, is that it isn't. But again, there could be some nuances there about the type of relief it is, or the type of factual situation that you're in. But then just know that there is this proposal out there that would clarify this issue and kind of put that issue to bed for now. But broadly, what we're seeing is, you know, folks aren't paying B&O tax on grants they're receiving. And this would just clarify that issue. Yeah,
Question. So I know a lot of people got PPP loans. Are they supposed to be filing sales tax or B&O tax on PPP loans?
No, and this is that same type of concept, Christine. Is there's question about whether it should be subject to it. I haven't heard of any of our clients that are paying B&O tax on PPP forgiveness.
Okay, is an entity out there trying to make that happen? Is there some legislation out there that's trying to make that happen, or is just for clarification on the rules?
Yeah, good question. I'm not aware of anything out there that's trying to make this subject to it. This is more of just a clarification to make it clear how that situation works. So, good question.
Phil, if I may parlay off that, Christine and I have spoken about this at length over the past year as we had to pivot a lot.
Yeah.
Question on the PPP loan, for those of us that received it last year, we are working now, yes, we are considering that income, but it paid for some very specific things. Do those very specific things then continue to be an expense and write-off? Or because it was income, you know what I mean? We would have written off our rent, our lease. I'm using this as an example, people, but there's some things that we as a business used that for, because that was how it was intended.
Yep.
And now it seems like it was pushed out, and now they're like, oh, and then there's the second half of how you reconcile that at the end of at you know, coming up this year. How are you addressing that?
Yep. So that's a great question, and it was kind of a long, winding road last year. The CARES Act.
I can't hear you. Can you get closer to your mic a little bit?
You can't hear me again?
Yeah.
How about now?
Yes.
Better.
Okay. The way that CARES Act was written was unfortunate. It didn't address those issues, and so after the CARES Act passed, that's why there was all these questions, because it didn't address how that would work. Throughout the summer, the IRS addressed some of those questions, and it caused a lot of confusion and frustration and inconsistencies with the stated intent of the program. So I'll skip over all those nuances in the middle. At the end of December, Congress passed legislation that clarified all of those issues. And they said expenses that you pay with PPP funds are deductible, and the PPP loan that you have forgiven is not taxable as income. So you still get to deduct the expenses you paid with the PPP funds, and you do not have to pay tax on the loan forgiveness either. So that's where things shook out you see lots of stuff, and there was lots of confusion during the year about how that would work. You can ignore all of that stuff because Congress fixed it in December and just clarified the whole issue and said you can still deduct and you don't have to pay tax on the loan forgiveness.
Thank you.
That answer? Okay, great. There are, I'll get into some more slides later, but there are some questions. The timing of it is kind of uncertain. You know, what if you still have the loan as of the end of 2020, but it hasn't been forgiven yet? What if what if you think it will be forgiven? What if it's forgiven before you file your tax return? How exactly do you report all of those things? We can talk about the specifics of those types of things a little bit later too.
Christine, do you have a question? Oh.
Okay.
No problem.
B&O or bad debts. I'll just touch on this really quick because this is a recent case that passed, or a court case that was considered. It went all the way up to the Supreme Court in Washington State. The question here was, who do you get to take a deduction against your B&O tax for bad debts? And the fact pattern here was Lowe's, contracted with a bank to provide the Lowe's credit cards. And so the question was, who's entitled to a bad debt deduction for B&O tax purposes if those customers don't pay on those credit cards? And the Department of Revenue took the position that Lowe's was not entitled to a B&O tax deduction for bad debts because it was actually the credit card company, the bank, who was left on the hook, basically. There was some reimbursement clauses in the contracts and so forth. Basically, it got appealed all the way up to the Supreme Court, and the Supreme Court ruled that Lowe's is entitled to a B&O tax deduction in that situation because they were reimbursing the credit card company for any actual bad debts that the customers did not pay. So they were allowing for a B&O tax deduction. It's kind of a specific situation that occurred, but it was an interesting court case that ran its way through the whole process. So there is a proposal now. Where is it here? Yeah, so because of that court case, there's currently a proposal in the legislature to address that specific issue and make it clear when a seller is able to claim a bad debt deduction or not when they have a third-party creditor involved. So that's an interesting scenario. If you have that fact pattern, something just to keep in your mind that there's something going through the state legislature there. A few other changes that occurred. There's been lots of changes with Nexus over the years. I won't spend too much time on this because we're talking to a group of local businesses here, but basically they're changing the thresholds for what types of businesses are subject to Washington taxes. It used to be that you needed some level of like physical presence, or there's different factors that would need to be met before an out-of-state business might be subject to Washington tax. They've changed that essentially to just be a gross receipts test. So if you've got $100,000 of gross receipts sourced to Washington and you're an out-of-state business, you now have Nexus and you now are subject to Washington taxes, even if you don't have a physical presence here. So again, this probably doesn't make any difference to the group here since we're all domiciled in Washington and already subject to it, but just a statement there that there's always these Nexus changes that are happening with the states. And to the extent that you have sales going out of state as well, other states are also doing very similar things with their Nexus rules, what is and what is not subject to tax in various states. So this is definitely an area to keep your eye on because it's constantly changing. A couple other changes, there were some rate changes for B&O tax during the year that are noted here. A couple of the B&O preferential tax rates for aerospace manufacturers were repealed. during the year. So if you have any of that activity going on, you're probably aware of that already. But there are still other incentives available for those types of businesses in terms of property tax credits, R&D credits, and things of that nature that are out there. So this is just another example that the B&O rates and other incentives are constantly changing as well, even depending on the industry that you're in. And then the real estate excise tax, I'll just comment on this briefly. When you sell a piece of real estate, there's real estate excise tax. They changed, historically it's been about 1.8% in that ballpark when you sell a piece of property. They changed that rule starting at the beginning of 2020. So now it's a graduated tax rate depending on the sales price. And you can see it there on the second bullet. So if you're selling a piece of property under $500,000, then the rate is 1.1%. And then it goes on up based on the value of the property. So it just is, just, you know, highlighting the issue for you. The real estate excise tax is still alive and well, and it's they've kind of changed it to increase the rate on property values that are higher. The bottom two bullets here I'm going to touch on. This also applies to entities that own real estate. So if you're planning, if you have some family planning, or you're transferring some ownership to a new owner or something like that, if you have real estate inside an entity, you could trigger real estate excise tax just by transferring ownership in that entity, even though the deed of the real estate itself is not changing. So this point here, the rule for that used to be a controlling interest in real estate was a 12-month period of time. And so the planning that would always be done is, okay, transfer half of it now, and then transfer the other half 13 months from now, and then you don't owe real estate excise tax. The state became aware of this and took them a while to kind of catch up and update their laws, but now they've expanded that period of time to 36 months. So now it's much more likely that they're going to capture a lot of those planning ideas out there to elude the real estate excise tax. Are there any questions on the real estate excise tax or any of the other taxes we just talked about?
When you say on the graduated scale, is that the actual selling price, or would that be a listing price? It's just a selling price,
That's
right?
the actual selling price, right?
Very good. Cool.
And so that catches people by surprise sometimes, Matt. It's a tax on the gross. So whether you have a gain or a loss or whatever on it, that is irrelevant. It's the tax on the gross value of the property or selling price.
Gotcha.
Yep.
Yeah. It's like somebody can't come in and list it for $4.99, and if they say, oh, we listed for that, but it sold for $5.05, they got to pay the higher rate.
Right. Right.
Yeah, gotcha. Very good.
Okay, and I'm just going to touch on this one quick because it shouldn't apply to many or any of us in the group here. But Seattle has a new payroll tax that became effective for 2021, and I'm mentioning it here not because it's in Seattle, but because this is going to give us some insight into what other locations may be considering. Cities and counties and locations all around the state and the country are hurting for tax revenue. And in Washington, as we talked about earlier, because we can't implement an income tax, the local municipalities are coming up with other creative ways to get more tax revenue. This is an example. So the city of Seattle introduced this new payroll tax, and it applies to businesses that exceed a certain amount of payroll in the city of Seattle. And there's different rules and rates and stuff about how it all applies. But the gist of it is that it's an employer level tax. It's not like a withholding from employees or something like that. It's purely an employer tax. And so conceptually, like I said, I don't think anybody here is probably going to have to deal with this. But just keep this in the back of your mind. We're probably going to see more of this type of creative approach to generating tax revenue that's going to make its way into the other counties and cities at some point. Okay, and I won't spend any time on this really, just to comment on and reiterate what I said earlier about the state taxes. the state tax rules are constantly changing. So if you're selling outside of Washington state, or you have anything to do with customers outside of Washington state, you should be discussing that in detail with whoever your tax advisors are, because like I said, the rules are constantly changing. And this Wayfair court case that happened a couple years ago is kind of the tip of the iceberg for kind of a groundswell and shifting of how states approach taxes. So if there's any questions on that, I'm happy to discuss them or address them offline as well, but just wanted to draw your attention to that issue. All right, so next I'm going to move into the Biden tax proposals. Were there any other questions on anything that we just covered before I switch topics? Okay. All right. Now, just to caveat, it's on the slide and I said it. These are proposals. This is not current law, and these proposals are changing constantly. So it could be that some of the information on the slide could be outdated at this point if they've changed their proposals. But in theory, the concepts are going to be pretty constant. We'll circulate these slides, so no need to like write all this down, of course. And I'm not going to go in detail into all of these. I'm going to click through and I'm going to circle some of the main items I think are going to apply more broadly. So under current law, the corporate tax rate is a 21% tax rate. So that applies to C corporations, not partnerships or S corps. If you're a C corp, you're paying a flat 21% tax rate. The Biden proposal is to increase that to 28%. So if you're in a C corp environment, you can probably count on that tax rate going up under the new administration proposals. If you're not a C corp, if you're a flow through, a sole proprietor, S corp, you currently enjoy what's called the Qbi deduction, which is the qualified business income tax deduction. In essence, the way it works is you, assuming you meet all the qualifications and thresholds, what ends up happening is you pay income tax on only 80% of your business income. You're entitled to a 20% tax deduction. So in essence, you're only paying tax on 80% of your business's income. That's the current law. The proposal from the administration is to essentially remove that 20% deduction for taxpayers that earn more than $400,000. So if your business is generating income over that amount, you're going to go from paying tax on only 80% of your business income to paying tax on 100% of your business income. That is the current proposal for businesses. The bottom row there is about fixed assets. So under current law, if you buy equipment, machinery, office furniture, that type of stuff, you're currently eligible to take a 100% write-off in the year that you acquire those assets. You don't have to capitalize them and depreciate them over a period of years. You can write them off all in the same year. The Biden proposal, there's nothing specific on it. I didn't circle it because there's nothing specific. So there's no proposed change to that current rule, which is a good thing. But do note that 100% bonus is scheduled to begin phasing out in 2023. So a couple years from now, that ability to write off all of your fixed asset acquisitions is going to begin to phase out. So it's going to go from 100% write-off to 80% write-off. The next year, 60%, 40%, and so on. That's how it's currently scheduled to work in the tax law. So if you're planning for fixed asset acquisitions, it might be something to consider getting those in by 2022 before that phase out starts to kick in 2023. Okay, a couple other business provisions that I'm going to highlight here. One is specific to real estate. You may be familiar with what's called a like-kind exchange or a 1031 exchange or a deferred tax. There's all kinds of things that it's referred to. Basically, if you sell a piece of real estate and you buy a piece of real estate within a specific time frame, you can defer paying tax on the sale of the first property and roll it into the purchase of the second property so that you don't pay tax until you dispose of that second property. It's been around for a long time, and it's a big planning technique for in the real estate industry and for businesses that own real estate. The Biden proposal is to remove the 1031 law altogether, so that no longer can you do 1031 exchanges. That would be a significant change to the tax law. The economists and the lobbyists that we hear and read commentary on, there's lots of proposals here, but from the administration. But what we're hearing is they're not going to be able to get buy off on all of these things. And in my opinion, this 1031 exchange provision would be one that I would expect probably not to pass, because the real estate has a very strong lobby and there's lots of people that would be really, really strung out if they took out this 1031 exchange provision. So that's my own personal opinion. I have no basis for that thought other than that's my own personal thought. But as it stands, the proposal is to remove that 1031 exchange. So if you're planning for some sales of real estate in the future, again, that might be something to move to the top of the list to start thinking more about now rather than later. Okay, I'm going to turn to individual.
Phil, can I stop you there for just a second? And I don't want to go down this rabbit hole because I don't know how many people that this applies to, but the 1031, I've heard the same thing that you just mentioned, that this is going to be a tough uphill climb. Yeah. However, there are some varying degrees I've heard of getting parts of this passed. For example, doing some sort of a moratorium or a sunset on some of the 1031 rules that are there now. Have you heard anything about that?
I haven't heard anything on that specifically, but I'm glad you mentioned it because that's how the sausage is made. This is all negotiation, and if it's not all one thing, there might be a process to get to that point over a period of time. So it could be based on your income. It could be based on the value involved, where they say over a certain amount is not eligible, or it could be anything. But the proposal is just to eliminate it. So that's a great question, though. Thank you. So some individual provisions here. I believe I'm just with my circles. I'm just circling the whole slide here because the whole thing's important. I'll just move from the top left and move my way down. So from an individual income tax rate standpoint, the highest marginal tax rate currently is 37%. The Biden proposal is to increase it back to what it was before tax reform of 2017, which was 39.6%. So about a 3% increase in the highest marginal rate. Now, if you think back to what I was talking about on the business side of things, with that 20% tax deduction, if under current law, if you're in the highest tax bracket and you're a flow-through business that is receiving that 20% deduction, you're actually paying tax at a 29.6% rate. That's 37% less a 20% deduction on that business income. So under current law, if you're in the highest bracket, you're paying tax at a 30% rate. If these proposals pass with phasing out the 20% deduction and increasing the highest marginal rate, you will be going from what is effectively 30% today all the way up to 40%. So it's a 10-point percentage increase from the current law to this proposal, and when you combined the repeal of the 20% deduction and the increase in the highest marginal rate. So quite a bit of an increase. And from a planning perspective, the things that we're talking about with clients is from a timing standpoint. To the extent you're able to, does it make sense to accelerate income into the tax year 2021, assuming tax rates change in 2022? Bring income in, pay it at a lower rate than you would have otherwise if you let it hit in 2022. That's just an example of what's being discussed. The second row there, excuse me, the second row there is capital gains. The proposal, currently the capital gain rate for long-term capital gains is 20%, plus a 3.8% Medicare tax. So in essence, it's 23.8%. The proposal from the administration is to increase that 20% rate to the highest marginal tax rate for taxpayers that earn more than $1 million. So if you have $1 million of income and long-term capital gain, the proposal is that it would be taxed essentially at that rate right above 39.6 plus 3.8%. So that's essentially going from what's 23.8 all the way up to about 43.8 on long-term capital gain. So that's a 20% increase for those keeping score at home. Again, that's only for taxpayers with income over $1 million. So if you're under that, the proposal wouldn't apply to you, and in theory, you would still be paying that capital gain at the 20% rate. From a deduction standpoint, I won't get into the nuances of the detail here, but I'll just say the proposal is to cap the benefits of itemized deductions. They're trying to limit the amount of deductions that you're able to take. And the proposal is essentially to cap the actual benefit of your itemized deductions at 28%. How that would work, what the mechanics of it are, we don't know. But the proposal is if your deductions exceed 28% of your income, you're going to be capped at only being able to deduct 28%. The bottom line here is about estate taxes, and this is a really, really big one. So from federal estate tax, currently, the exemption per person is $11.6 million. So what that means is each individual can pass assets worth $11.6 million estate tax free. That is currently scheduled to sunset and reduce down to about $5 million per person. So about half of the current exemption is going to go away in 2026. The Biden proposals out there are to make that decrease even further, down to maybe like $3.5 million. And the bigger piece here, or one of the biggest pieces here that I'm going to touch on in the bottom right, is he's proposing, or the administration is proposing, to eliminate the step up in basis on assets that are inherited through an estate. And I'll provide some background on that. So if someone passes away and leaves assets to their kids, their spouse, whoever their beneficiaries are, from an income tax standpoint, those assets get stepped up to whatever their value is on the date of death. So let's say someone's owned a piece of real estate for 50 years. And let's just say the basis that they have in that asset is zero. They fully depreciated it or whatever. Their basis is zero. But as of today, let's say it's worth $1 million. So if they were to sell that property, they'd have $1 million gain on it. If that person instead passed away and that asset went through that person's estate, under current tax law, their basis in that asset gets fully adjusted to the current fair market value of $1 million. So if the estate or their beneficiary sold it, they would have zero taxable gain from an income tax standpoint. This proposal is to eliminate that step up altogether. Again, the idea is they're trying to capture and generate tax revenue here. We've got a lot of deficits going on in the country, and they're trying to find ways to capture that. And this is one of those places that they're kind of honed in on, is eliminating that basis step up of estates. Any questions on this slide, on the individual stuff or the business stuff? Okay, I'll keep going. COVID relief. Again, some of this stuff is going to be familiar. Some of it's going to be somewhat new. So here's kind of a timeline of the things that have happened over the last year. The Families First Act passed in March, which was kind of the first shot to get some relief going. The CARES Act, of course, introduced PPP, and it changed the tax law in a variety of ways. It expanded the NOL provisions of how far back you can carry net operating losses from a business. It introduced the employee retention tax credit. It had the PPP stuff in there, and it fixed a variety of other issues in the tax law. So the CARES Act was a big one. It itself had a lot of issues. And so what we saw at the end of the year is the Consolidated Appropriations Act, which itself provided for some new relief, and it fixed and expanded some of the relief that was provided by the CARES Act. And it did some of that retroactively back to March of 2020. So there's lots of moving pieces here, and I'll touch on a couple of them here. So here we go for businesses. PPP. We touched on this earlier. The act that was passed at the end of the year explicitly clarifies that you can still deduct the expenses paid with PPP funds, and the forgiveness itself is not taxable. There was a lot of confusion about that, a lot of uncertainty, but this bill clarified that issue. Okay. It also introduced round 2 of PPP, which currently is available through the end of March for application. And essentially, you probably are aware, in order to qualify, you have to have gross receipts that have been reduced by at least 25% in any calendar quarter in 2020, compared to the same calendar quarter of 2019. If you meet that 25% reduction, then you pass through that qualification and you're eligible to apply for a round 2 loan. They also freed up some of the other qualified expense buckets of what you can use the funds for, to include things like operating costs, software, cloud computing, and if you're paying for things that are a result of disturbances, you know, if you're having to pay for expenses related to COVID, worker protection costs, things of that nature, those can also be forgivable PPP expenses. Now, with the expanded covered periods, most of the clients that we're working with don't have an issue meeting that threshold because they've got plenty of wages during that period of time. There could be other reasons why, though. You may not want to just use all of your wages to be eligible for forgiveness. You may want to rely on some of these other expenses as well. And I'll touch on some of those things, but wages in general are kind of a hot topic of things that are eligible for other relief provisions. And if you use them as a basis to get your PPP loans forgiven, you may be giving up some benefits somewhere else for some other relief that you may otherwise qualify for. So that's the concept behind that. As I mentioned, the covered period is still the same. You can choose between the 8 or 24 week period of time, and there's a nice streamlined application if you have a small loan. So this is round 2. Round 2 also changed some other provisions. So you can't get a loan for more than $2 million. In PPP round 1, the maximum loan was $10 million. So they, you know, reduced that a fair amount. And you have to have fewer than 300 employees. There's aggregation rules. So if you have commonly controlled businesses, you have to combine them and count employees and so forth. So that's something to be aware of there. And then there's that 25% drop in gross receipts that I mentioned earlier. Any questions on the PPP? Okay. State conformity, again, I'll just touch on this at a high level because it's more complex than we have time for, but the states that have income tax are all over the board on how they're treating this PPP stuff. So some states have not commented on how they're going to tax it. If they're going to tax it, it depends on how they conform to the Internal Revenue Code. If they have a rolling conformity date, if they conform to the Internal Revenue Code as of a certain date, it's all over the board. So if you've got a multi-state tax situation, consult your tax advisor, certainly. Okay, the family sick leave, that was expanded. So it used to end at the end of 2020. They expanded that through March 31st of 2021. So if this is something that you were being able to take advantage of previously through the end of 2020, know that it has been expanded through the end of March of 2021 currently. And I'll take take a quick second just to mention the current proposal the administration is working on passing, the $1.9 trillion bill that's being put through Congress right now. I haven't seen the text of the specifics to it, but what we are hearing is some of the provisions in there would further expand these applicable dates of some of these programs that we're talking about right now. So this slide says that this is currently extended through March 31st, 21. That is the current law, but it's possible that could get further extended as a result of this 1.9 trillion relief package that's moving through Congress currently. The employee retention tax credit, I'm going to take a couple minutes on this one because I think it's really important. The employee retention tax credit was introduced by the CARES Act, and the CARES Act explicitly prohibited businesses that received PPP loans from qualifying for the employee retention tax credit. So from March of 2020 through December, and whoever got a PPP loan, this was irrelevant. And so it didn't get a lot of attention for those businesses. Fast forward to December of 2020, and that new law that was just passed, they retroactively changed the CARES Act and made it so that PPP recipients can now take advantage of the employee retention tax credit. And they can do it retroactively to March of 2020. So now there's it opened a whole Pandora's box of opportunities for companies that previously were not eligible for this program. I'll talk about the details of it and you can answer questions on it, but just want to make sure that this part of this is very clear. If you have a PPP loan, you are eligible for the employee retention tax credit. There are requirements that you have to meet in order to actually benefit from it, but you are no longer precluded from the program just because you got a PPP loan. Okay.
Phil, sorry to interrupt here. Does the RTC, is that available for nonprofits as well, or is it just corporations?
No, it is also eligible for nonprofits.
Very cool. Thank you.
Yep. So another thing that it did is it expanded it, just like the previous slide. This was scheduled to only be applicable through the end of 2020. The bill that they passed in December extended it through Q2 of 2021. So this tax credit is from March 2020 through June 21 currently. This is one of those provisions that we're hearing potentially could be extended through the end of 21 as part of the current legislation. So keep your eye on this one for sure. This is a chart that you will see in the slides. If you Google this, you'll see articles about it. Moss Adams has some articles that are out that contain this detail, so I won't go into it in great detail, but I'll tell you just at a high level. If your company experienced a reduction in gross receipts of at least 50%, 50, so a pretty significant drop in gross receipts, compared to the same calendar quarter, 2019 to 2020, then you are eligible for this credit. Or, so that's one way that you can be eligible for the credit. There is an OR test, and the OR test is regardless of whether you had, how much your gross receipts were reduced, if your business was impacted by a partial or full suspension due to emergency orders from a government, then you could also qualify for this credit. So there's lots of nuances in that. Well, of course, most businesses were impacted in some way by government shutdown orders, right? So the question becomes very fact specific. What is your business? Is it an essential business? Because the rules are a little bit different if you have an essential business versus a non-essential business. But just understand that it's an either or test. Either your gross receipts go down by more than 50% for any one quarter, or you meet these tests of being impacted by partial or full shutdowns. If you get through those two filters, then it's just a question of how much the credit is going to be for your business. and at most it's $5,000 per employee in 2020. So it's a 50% of wages that you pay employees capped at $5,000 of a credit per employee. So it can be pretty, it's a really good relief mechanism that they put in place. It doesn't always work, to be candid. There's rules, and sometimes situations seem like it should apply given the specific fact circumstances, but the way the credit works is also very specific. And if you fall outside in any given way, it may not function the way that in theory you would think it should. Okay. The other thing I'll mention on this is they changed the rules of how it works for 2020 to 2021. So instead of a 50% gross receipts reduction that applies in 2020, for 2021, they changed it to only a 20% gross receipt reduction. So if you're looking at Q1 2021, all you need is a gross receipts reduction of 20% or more, and then you're eligible for the credit. So there's moving pieces, and the credit is better in 2021. So instead of being capped at $5,000 per employee, in 2021, it's capped at $14,000 per employee. So there's real dollars here, and it's certainly worth the time to consider whether this applies to your business. Any questions on this before I move forward? Okay. Let's click through my boxes. I didn't realize I had all those there. Okay. As I said, PPP recipients are now eligible. This is some mechanics on how to claim it. You basically claim this credit on your payroll forms. So this is not an income tax credit. This is a payroll tax credit, and it's refundable. So you can file a 941X and actually claim a refund from the government for periods that you've already filed. Alternatively, you can take that credit on a current 941 form that you haven't filed yet. So there's real ways to immediately recognize the benefits from this credit. You don't have to sit around and wait to file your income tax return a year from now. Just a comment here that I alluded to earlier, there's some strategy here because all these different relief provisions, they're not going to let you double dip on the wages that you're using for one relief provision in another relief provision. So you can't get forgiveness on wages for PPP and also use those same wages to claim an employee retention tax credit, for example. The strategy there is capture more non-payroll costs in your PPP forgiveness, get your full forgiveness still, and then claim the employee retention tax credit on the rest of the wages, for example. A couple other relief provisions that are out there. Starting in 2021 and 2022, businesses are allowed to deduct 100% of meals expenses that are paid to restaurants. So the idea here, get more business going to restaurants. And the idea was, well, if we let businesses deduct 100% of those costs, maybe that'll start getting some relief directed toward restaurants, for example. In the past, you're only able to deduct 50% of those types of costs. So for 2021 and 2022, they made it so that you can deduct 100% of those costs. Yes, Annika.
So like if I grab Starbucks or some coffee, whatever, and snacks for a client, I take it up and I can deduct 100% of that, but it has to be somehow client or meeting related, or like kind of what are the stipulations around that?
Yep, you still have to fit within the same parameters of it being deductible in the first place.
Okay.
But assuming you are in those parameters, instead of it being limited to 50% deductible, it's 100% deductible.
Cool, thank you.
Yep, good question. I'm not going to spend time on this, only to point your attention to it. There's a deduction that you can take for tax purposes if you're doing energy efficient building improvements. And historically, that expires every year. Congress scrambles at the end of each year to pass an extender bill to make it apply. They actually quote unquote fixed that as part of this bill. And now this 179D deduction is permanent in the tax law. So it's not going to just automatically expire by itself as it was doing every year in the past. So the takeaway, if you're doing some energy efficient building improvements, let's talk. There could be some additional tax benefits there for you to have. In addition to this deduction, there's a variety of other credits. Must be on a future slide. There's some energy efficient tax credits as well that you can take if you're doing that type of work. I know we're running short on time, and I just have a few extra slides here on the individual side. I'm sure you've heard all about the rebate payments. So there's more rebate payments coming if you haven't, if folks haven't received those yet. In the current $1.9 trillion bill, there's an additional $1,400 of these types of payments being proposed that would also come through. So that'd get you up to $2 grand within the last few months for people receiving those types of payments. This is just a chart that shows based on your income when those benefits phase in and phase out. So I won't spend much time on that. I'll comment here, if for charitable contributions, if on your individual tax return, you do not itemize your deductions, that means you generally cannot deduct charitable contributions. They made an exception for 2021 and allowed for a very nominal charitable deduction to be taken by non-itemizers. That's what this is here, very small. The second bullet there is for people that do itemize. Generally, you can only deduct 50% of your contributions relative to your income in any given year. They expanded that and made it 100%. So if you're charitably inclined or you have a low year of income because of COVID and everything else, but you have the same level of charitable contributions, for example, they're not going to be capped at 50% of your income. You can deduct all the way up to 100% of your adjusted gross income this year. So that's a good thing. I don't know how many folks are going to hit that, but I mean, it's a good thing in theory. HSA, I'm going to touch on this just because it's different and I get this question a lot. HSA or flexible sending accounts normally are use it or lose it type of thing. For 2020 and 2021, they're allowing owners of those types of accounts to carry forward any balances they have in them. So you do not have to use it or lose it for the next 2 years. You can carry forward those balances. That was a good thing. A couple extender things I won't spend any time on. Like I mentioned, there's some credits for energy efficient property. So solar panels, you're doing any kind of energy efficient work, there are credits available for that stuff. That's what all of this is referring to. Okay, so where does that leave us? There's planning to be done. Some of this stuff, it just is what it is. There's not much you can do about it, but some of it, there's planning. Like I mentioned, the PPP relative to the employee tax credit, there's some real good planning that you can do there. Fixed assets, if you're gonna be acquiring fixed assets, do it before the benefit of immediate write-off goes away in the next couple of years, for example. From a timing standpoint, as this year goes on, if it becomes more clear that there will be tax changes effective for next year, talk about timing. Do we defer some deductions to next year when the tax rates will be higher? Do we accelerate some income from next year to this year in order to pay it at a lower rate? That's the type of planning that we're hearing a lot of right now. Even your accounting methods for tax purposes. Would it make sense to change some of the methods of accounting that you have in order to capture some of these benefits? So it's fact specific to your situation, but you know, there is some proactive stuff that you can do here as the year progresses. That is the end of the prepared stuff I have. I'm 1 o'clock and I used up the entire time slot, I think, so I apologize for that. If there's any questions, I'm happy to take them, or if we're totally out of time, certainly you can reach out to me anytime and I'm happy to talk with any of you about your questions. So I'll turn it back to you, Matt.
Thanks so much, Phil, for being here. It was a lot of good information. We appreciate that. There's a lot to get through, so we totally understand. It took up a lot of time. So complicated subject, to say the least. So any questions for Phil at all?
This was great information. Thank you.
And if you want to review any of it, Phil's going to send me the slide deck, and I'll send it out to everybody who was registered. Right, Phil? Is that correct?
Yeah, definitely. Yep.
Excellent. I'll send it out to anybody who's registered, as well as the video is going to be placed up on our YouTube channel. later this week. So if you need to review it or you want to go back and listen to the other parts of it again, feel free to find that out. Make sure that gets posted. Keep an eye out on our website and in our newsletter coming out on Thursdays for the links to that video, and that'll be there. So cool. I'm going to stop you sharing, Phil, here, and I'm going to steal it back here real quick, like. And yeah, just again, thanks, Phil, for being here and for giving us a lot of good information. Really appreciate it. Before y'all go, I just want to give you a couple of quick bits of information here. I still have, I want to remind you all that we still have the Safe Start kits for small businesses that were put together by the Snohomish County Department of Emergency Management. If you're a small business in the Greater Lake Stevens area and you are in need of PPE, reach out to me. I have kits available, and this is what all they include. They include the non-contact infrared thermometer, a couple boxes of gloves, both disposable and reusable masks, and those 2 large bottles of hand sanitizer. All that's in the box. And so if you want one of those, please reach out to me. I'd be happy to even deliver it to you. I'll bring it to you if you want, no problem there. Or I can arrange to meet you, or you can swing by the office here, no problem. Once again, I want to thank our silver investors for 2021: Waste Management, Heritage Bank, Wells Fargo, and our newest silver investor, First Financial and Northwest Bank. Appreciate them. And of course, our gold investors, Community Transit and Ace Hardware from Lake Stevens. So thank you all again for joining us. We appreciate you being here. Thanks again, Phil from Moss Adams, for being here and trying to bring us up to speed on all the changes and everything in tax code and stuff. It's an ever-changing, moving goalpost sometimes, we know. So, but we appreciate your knowledge and sharing that with us. We appreciate it. So,
sure. Thanks for having me.
Absolutely. Thank you, everybody. And we'll see you again. Reminder, next week, networking after hours, week after that, morning mingle. And next month's luncheon, we'll have Mayor Brett Gailey from Lake Stevens on Connect with Brett here. We'll see you again soon. So thank you all for coming.